Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, I want to talk about the company that I think Ryan Cohen is most interested in purchasing and his fallback and fallback to the fallback if he's unable to purchase the one that he has his eyes set on. I want to make the case for you in this video. Would love to hear in the comments what you guys think. Before I get into it, just want to say thank you to those who joined the channel as fans and as friends. Also, thank you for the subscribers, the likes, the comments, etc. We are on our march to scale Mount Fuji together. We are trying to get to 3,776 subs. Would love for you to be a part of it if you get anything out of this. So let's start with what are the conditions set out in the article. In the Wall Street Journal, he said major acquisition of a publicly traded company, likely in the consumer or retail industry, sight set on a handful of companies. He also bristles at the term meme stock. I think that's a clue. He also says there are a lot of diamonds in the rough that have sleepy management teams. That he did not fix GameStop to stop there. In the CNBC article, he says, again, a larger consumer company. It's going to be really big, very, very, very big. Cohen said, of the size of the acquisition. It's a huge clue. Transformational for GameStop and within capital markets, a publicly traded consumer company that's undervalued, high quality, durable, scalable with growth prospects, and a sleepy management team. If it works, it's genius. If it doesn't, it'll be totally foolish. His intention, right? He is confident that he has the ability to make the asset much, much more efficient. So, what does Cohen come in and bring to this large acquisition? He brings retail expertise and efficiency. Says they've got the governance structure, they've got the capital, they have the operational expertise. So it's a company that needs capital, right? If capital is a part of the deal and the company doesn't need capital, it doesn't fit the conditions. He called his new strategy way more compelling than Bitcoin, similar to Berkshire Hathaway, except what Berkshire did in decades, we're attempting to do in a much shorter amount of time in terms of generating that value. He's going to go in and he's going to implement the Chewy slash GameStop mindset of increasing the profitability very, very quickly so that we could capture a lot more value for the under optimized asset, eventually move on to the next one. So, how do I kind of summarize the conditions? Basically, the company needs to be larger than GameStop, right? We saw a larger consumer company, at least in terms of revenue, maybe in terms of market cap as well. It needs to be undervalued. It needs to be quality and durable. It needs to have growth and be scalable. It does not need to have NOLs or a high short percentage, but if it's similar to Berkshire Hathaway, this is infamously how Berkshire Hathaway scaled, is they bought companies with huge amounts of NOLs. They used that tax advantage through the NOLs to scale. The short percentage is just a way to say, it's a nod to this meme stock comment, right? And the diamond in the rough comment. Like how bet against is the company? This is not Cohen did not say anything about either of these, but I wanted to think about it. Do they need capital? So this is the company's debt to cash ratio. And then also for bonus, what is the strength of the balance sheet, right? Assets over liabilities. Some honorable mentions. So in my past videos, I have looked at dozens and dozens of companies. I've probably looked at hundreds in my personal time as well. These are all of the companies literally that meet all the conditions. The honorable mentions don't quite, in my opinion. Why not? Well, with AMC and Bath and Body Works, first of all, the scale has already been scaled. These two are already global companies and have been global for a long time. Also, the asset to liability ratio is bad, right? Like the balance sheet looks really bad. Also, Bath and Body Works, you're stuck inside of a mall. I don't know if Cohen wants to be inside of a mall. And with AMC, you're stuck like with the service that is movie theaters. I don't think those are quality and durable, right? You could be the number one movie theater chain, but you're in a very undurable industry at that point. With Petco, the main reason I don't think he's going for Petco, one, I'm not sure if it meets the very, very large description. 6 billion in revenue, that is larger than GameStop's revenue, but it's only a $750 million company. Also, is it really quality and durable? Probably so, but it would be the number two pet store, not the number one pet store, right? PetSmart slash Chewy. The other thing is it growable and scalable? Sure, but the what Cohen would do is build Chewy, and Chewy's already been built, right? So like, I don't think that Chewy is so poorly run that Cohen can just do the company all over again and all of a sudden create some massive competitive advantage. Chewy still has a 60 PE, like it's still a highly valued company, and it's created a very loyal customer base. The people that want the Chewy experience, they still buy from Chewy, right? So I don't think it's Petco. Last honorable mention is Advance Auto. So a $3 billion price tag, $8.5 billion company. All of these are in orange because I don't think any of these fit the very, very big description, right? They're not red flags, but they're orange flags. Also, Advance Auto would be the number three auto parts store after O'Reilly and after AutoZone. They also already have 4,000 stores across North America, a lot of stores in Mexico as well. They do have some sweet NOLs and a high short percentage, but they don't need the cash, right? Their debt to cash is only at two. They only have two times as much debt as their cash, and that doesn't include, of course, all their other assets as well. But their assets to liabilities, not that favorable. So, for those reasons, I don't think these are the names. You start looking at what are the names that met the criteria, how similar in nature, right? Target, Macy's, Kohl's. So a couple things I want to talk about as it relates to this criteria. So this is GameStop's not looking to make a purchase that's a vertical or horizontal integration into GameStop. This is an acquisition of a different company that Ryan Cohen wants to go into and maintain it separately. Like it will remain a different company even after the turnaround turns or after the efficiency increases, right? It's similar to Berkshire Hathaway, a holdings company with lots of separately operating companies. Not what can we buy to make GameStop the most powerful collectibles or most powerful gaming company in the world. That's not how he's thinking about it. Secondly, this acquisition is not a totally different sector. Both articles talked about this is in the consumer slash retail sector. Beyond that, this is a company that Cohen and his leadership team feel that they have an expertise gained from Chewy and GameStop that they can go in and apply the same expertise into the company that they purchase, right? If they go into financials or tech, for example, which some people are very excited about, how does that line up with a retail company that they can apply the efficiency learnings from Chewy and GameStop and then potentially move on to the next one, right? It's this rinse and repeat. And I think it's within retail that um, that makes the most sense. And the articles both mention that it would be in retail, or at least that it would at least be consumer. But at least one of them also mentioned retail specifically. Target, Macy's, and Kohl's are literally the only consumer facing retail companies that meet all the criteria described, even including e commerce companies that I looked at. eBay, for example, several criteria that eBay does not meet. So, another couple interesting thoughts here. So, in my last video, I had a great comment talking about Kohl's, saying, hey, he could buy Kohl's. They have this much in revenue, this much in real estate. He could do the store within a store concept, right? He could also buy a Bed Bath and Beyond Overstock. He could also buy a children's place. He could also buy a whatever he wants, 1-800 Flowers. And he could create a store within a store concept, capture all of the short percentage NOLs from these other associated as meme stock companies. And then guess what? Kohl's has all this asset value in their real estate. They could do sale leasebacks, raise a ton of cash, and then move on to the next one from there. That is true, but it also does happen to apply to Macy's and Target. In fact, Macy's has much more in real estate value, maybe not much more, but more real estate value than Kohl's does. Target has much more real estate value than Macy's or Kohl's does. So the store within a store, scooping up several brands, it applies to all three of these. It also, I don't know how many of you guys mentioned back when Teddy Holdings LLC was doing its business licenses and all of its registration, but a lot of the things it was approved of, it was like a lot of these random consumer goods that had nothing to do with GameStop that made people think, is GameStop going to buy Bed Bath and Beyond or whatever? All of these companies, Target, Macy's, Kohl's, would fit under those license registrations, and all of these could double with the NOLs and legacy short interest from BBBYQ, aka DK Butterfly, aka the legacy Bed Bath and Beyond, whose last scheduled bankruptcy court date is February 20th of 2026. Doesn't mean there won't be more put on the calendar, but it's looking like that's supposed to really be the end of this whole journey. If you take in DK Butterfly's NOLs, that's 1.6 to maybe all the way to 4 billion has been speculated. We don't know yet. And then short percentage rise. Like if you've been following GameStop for 5 years, you know about seller boxing. You know that when a company goes bankrupt, shorts do not have to close. But if that same company with the same QSIP were to reemerge, that all of a sudden those shorts would be back online. So any of these companies, Target, Macy's, Kohl's, would be able to, if Cohen does also buy DK Butterfly, the short interest from DK Butterfly would be added to the pie, and the NOLs from DK Butterfly would be able to be used. NOLs have to be used in the same type of business. So the NOLs were generated from the legacy Bed Bath and Beyond brick and mortar store that sold home and bath goods. Guess what companies sell home and bath goods? Target, Macy's, and Kohl's. So you can't use the NOLs from DK Butterfly on a TikTok. Like it has to be the same business category that you're using the tax losses for. So that's just another synergy with all of these names to things that have been speculated about for a long time. I also want to address some people who say, but it's never been done before in capital markets. Look, he said ultimately transformational within capital markets. So it can't be Target or Macy's or Kohl's. Well, I think it totally can be. Okay, we have never seen a brick and mortar company scale into a 100 plus billion dollar company from the ashes of bankruptcy that GameStop was in. We've never seen that. That level of a turnaround. It has never happened, right? Never been done before. We've never seen a holding company of several premier brick and mortar companies across America. And if this continues to roll onto more names, right? How many stores and huge consumer brands with their own physical footprints is GameStop interested in holding? We've never seen a holding company like that before. We've seen holding companies of totally unrelated sectors and companies. We've seen holding companies of products that are in the same type of field. We have not seen a holding company of totally independent, but all in the retail sector, brick and mortar stores. So we've never seen that before, right? We have never seen Wall Street crack down on short selling. We've never seen the gravity of naked short selling exposed. Okay, so if these purchases trigger some type of um, cataclysmic event for short sellers, that would obviously be transformational for capital markets, especially if the markets respond by demanding a change to structurally how capital markets work, right? So that would be transformational. We've also never seen GameStop's stock squeeze. We saw it sneeze in January of 2021. We have not seen it squeeze. So if GameStop, through these acquisitions, triggered a short squeeze, are we able to find out just how high it could go? And if it goes as high as people have thought it could go, is that something that's never been seen before? Yes. So there's so many ways that all of these would imply something that's never been seen before. I think if you cannot accept all four of those reasons that I just said that are clearly true, I think you're reading way too much into that one specific quote and not reading the whole article. Because there are a lot of qualifiers, a lot of criteria that Ryan Cohen describes. And that quote about it ultimately being transformational, it's not even really a criteria, right? That's just a bold promise. But let's dive into why I think Target is the name that Cohen is most interested in, but that he is content if he cannot acquire Target, if Target refuses for some reason. I think Macy's is a strong second place. I think Kohl's is a distant third place. Let's talk about Kohl's real quick. So, first of all, the assets to liabilities, like the balance sheet's basically half as good as Target and Macy's. Yes, they have real estate. Target and Macy's have more and less liabilities to go with it. Kohl's desperately needs the cash. 31 to like 31 times the debt to cash. Also, if everything goes right with Kohl's, you might be the second best department store. If everything goes right with Kohl's, you might be the second best mom store. Like you might be second to Macy's, you might be second to Target. But Kohl's as a brand is not quality. It doesn't really stand a realistic chance to anytime soon become the number one in its industry, which Chewy became the obviously the premier pet sourcing, especially online pet store. GameStop is the premier and the only video game retailer. I think Ryan Cohen likes playing to the best to be able to charge more, right, for customers that want its like that retail's products. Also, it's only $2 billion. Is that very, very, very big for a company that literally has 10 billion in the bank in GameStop? Is that so big to buy Kohl's? I don't think so. I don't think so. Revenue wise, it is bigger, right? It's five times almost what GameStop's doing in revenue. And it is very undervalued. Like the price to sales at a 0.125, Certainly, if he's going for just all he wants is the best, the most undervalued, the better, then that would certainly make you think he could be interested in Kohl's. But that's not the only criteria, right? That's just one of the criteria. And I think for some reasons, Kohl's is not as likely as Macy's and Target. Let's dive into Target, why I think it is the name. First of all, and these are all in no particular order, but the Mark Tritton connection. Mark Tritton, guess what he used to do? Okay, he used to be on the board of Nordstrom. Does anyone remember when Ryan Cohen bought into Nordstrom and then sold it for a profit? You know what he did before Nordstrom? He was the CEO of Bed Bath & Beyond. He was the guy who took Bed Bath, the legacy Bed Bath & Beyond, to the grave. What did Ryan Cohen do? He bought Bed Bath & Beyond and tried to take it over, but ultimately was rejected by their board. What did Mark Tritton do before Bed Bath & Beyond? He was a VP at Target. So literally, Ryan Cohen's obviously does not think super highly of this guy, Mark Tritton, and is like, you know who I know for sure is a shill? You know who I know for sure is destroying the value of companies? Mr. Mark Tritton. So if I, as an active manager, want to redeem or find deep value within retail in America, why don't I just take over whatever he's trying to take down? I mean, this would be three for three. That's interesting. That's obviously not true for Macy's or for Target. What else? S&P 500 inclusion would be immediate with Target. Macy's and Kohl's are not in the S&P 500. Target is. If GameStop overnight becomes a member of the S&P 500, how much does that enhance the value of GameStop, force shorts to close on GameStop, right? Create upward momentum from a technicals perspective on GameStop, which, by the way, would trigger all of the warrant and convertible price tranches basically overnight, which then means there's, that 10 billion in cash becomes 10 billion in net cash, 2 billion more coming from the warrants. So now we're talking 13 billion plus net cash for GameStop. Target's the only one of these three that would put GameStop automatically into the S&P 500. I think that's very interesting. What is something that we know Ryan Cohen has spoken against several times that he doesn't like about certain companies? Think liberal agenda. Think go woke, go broke, right? Ryan Cohen hates wokeness. Target is maybe the most woke brand ever. And I think Ryan Cohen would view that as an opportunity. I think, and he said as much, almost verbatim. I covered this on my channel. If you want to, man, I almost just want to show you what video it is because it was so on point. It was, oh, the honest evaluation of Cohen's management tenure. This one right here, we go through all of Ryan Cohen's statements that he made for GameStop. He talked about how much he detests the way that Wall Street goes and also how much he detests DEI initiatives, for example. And he said it's precisely what creates opportunities. I think in Ryan Cohen's mind, he sees Target as a company that has gone so um, employee centric, culture centric, DEI slash whatever you want to call it, liberal slash whatever centric, that they have almost artificially destroyed some of their power as a business, some of their efficiency as a business. And I think Cohen could go in and say, why don't I just take a business first mindset and then let employees benefit from the appreciation of the business if they want to. So Target's been like targeted since really 2020, like people uh on like the religious side of the world, which by the way, in America, if you're selling to moms, what percentage of moms identify generally as Christian in America? It's literally like 80%. And these articles were going viral back in 2020, 2021 of all like basically there's this product designer at Target that's uh, publicly like a huge Satanist, and look at some of the stuff, some of the like gender sensitive clothing that they're making for like 3-year olds, 4-year olds, right? And so a bunch of people on the political right and on the religious side of the spectrum started boycotting Target. And look at what Target's done in the past 5 years. Peak in 2021, and they are now almost a third of what they were then. Like that is what happened to Target, which is one of the prime examples of the go woke go broke mindset. Well, guess what? In 2025, they did it again, and they're like, "Hey, we're not going to do DEI anymore." And so now everyone on the left is pissed at Target. And I mentioned in my video on Saturday how they're, headquartered in Minneapolis, and that in itself is somewhat of a risk. Um, but something that could be easily like resolved by moving the headquarters. And they've already pissed off the woke side of their customer base, but they haven't gained trust in the conservative side, right? Because they haven't like all they've done is like we're not going to do DEI, but they haven't like swung to the right, right? They're such a confused cultural brand. All that to say, I think that shows a potential for business value that can be quickly rectified. We know speed is on Cohen's mind. He talked about doing things, accomplishing something in a much shorter period of time. Um, as it relates to the efficiency, right, that Cohen is interested in bringing in, right, to make it much more valuable through increasing the profitability and brutal efficiency, right? He's not going to basically, the larger the revenue base, the larger the upside for that opportunity. Because Target is already so huge, any ability for Cohen to move the needle basically has 5 times the impact as Macy's. So if Cohen can go in and cut down corporate spending, fire some overpaid executives, what do you think the executive payroll is for Target compared to Macy's? Right? If Cohen can go in there with some product assortment or with some employee headcount and say, "Hey, I think we can get 5% more operating margin through cost cutting on the business front." Well, guess what 5% is going to do for Target versus Macy's? It's going to do at least it's 5 times as much because the revenue is so much higher. So the huge revenue base implies that the efficiency and related EBITDA capture and related market cap upside capture is much higher with Target than a Macy's or a Kohl's. Also, Target has done the least of any of these three companies to get more efficient and to cut costs. Macy's has done a lot, like even right now, their leadership team is recently joined, right? They're only a year old and they're closing 150 stores. They only have 650 and they're closing 150 of them, right? They're very aggressive on cutting costs. They also own Toys R Us, which is very interesting, very fun. They already have 7 billion of their 22 billion in revenue comes from e-commerce, right? They are doing the things that they're doing some of the things that Cohen would want a company to do. They also don't need the cash quite as much as Target does, for that matter. And they're also tied to malls, which Cohen might not really be interested in, because that's its own level of risk and also its own risk of perhaps over inflated real estate values compared to a Target. Regardless, Target has done almost nothing to get more efficient. And even now, right, they came in, new CEO has been announced. Just and what are they talking about? They're talking about innovation. Yet, a lot of the innovation they're talking about is stuff that they've already done, leaning again on old playbooks. Like this article, not that well. I mean, the amount of ads in this article is pretty wild. Multi-year strategy aimed at returning to growth. So Target is not going the cost-cutting route. They are going the scale, expand, new service, same-day delivery here, a little bit of new product there, right? They're betting on themselves through scale, but people that have been following the company are like, isn't this the same thing you said a year ago, right? Target is the has done the least to try to cut costs, which would imply that if Cohen's part of Cohen's value add is we're going to help cut your costs on the corporate level, cut the costs on the operational level, that would have the biggest impact within Target because they've done the least and because their revenue base is literally 5 times higher than Macy's. Talk about the NOLs, okay? So if they stack it with DK Butterfly or with other near bankrupt companies like a Children's Place or a 1-800 Flowers or whatever. Pick some companies that have high dollar value of NOLs. Which why does it matter? Because similar to Berkshire Hathaway, right? We know he cares about it. Except what Berkshire Hathaway did, we're trying to do a lot faster. Well, guess what? The NOLs are write-offs against your operating income. You know what Target's operating income is? It's like 3.7 billion is their net income. Operating is actually like closer to 5 or something. What does that mean? Cohen could use 100% of the NOLs in the first year if he bought Target. Macy's income is like 500 million, which means it would take 3 to 8 years to use the NOLs just from DK Butterfly. With Target, he could scoop up several other near bankrupted names with their own NOLs, use them all at Target, all within the first year if he wanted to. So the impact of that tax savings, right, going from 20% is getting taken out to nothing is getting taken out. Well, guess what? The difference of that is 5 to 3.7 billion, right? Like it's it's another $1 billion in cash that can be captured right away in Target that it would take you 3 to 8 years to capture in a Macy's. And in a Kohl's would take you even longer. It would take you 8 to what is that? 8 to 20 years. So the NOL impact would be a much quicker implication in Target than in Macy's. Target also is the much sleepier management team. Check this out. This guy, Brian Cornell, has been the CEO for the past 11 years. 11 years of the same CEO that's seen this happen over the past 5 years. But he's getting replaced, right? Well, not really. He's being replaced internally by the COO who's been there for 20 years. Super sleepy. Compare that to the other companies. Macy's brought in Tony Spring in April of 2024, right? So they just hired a new CEO less than 2 years ago. And as soon as he came in, he said, we're going to start slashing costs. And by the way, I'll save it for actually another point here in a second. But I'll just tie it in here. Macy's was attempted to be purchased around this time, like mid 2024. Investor groups came and tried to buy out Macy's, and the board rejected it. They said, actually, we're doing just fine. We don't want to sell. We would rather realize the upside ourselves. Now, if the price gets high enough, I'm sure they would sell. Or if the terms are favorable enough for them, I'm sure they would. But this is not nearly as sleepy as Target. That's been rinse and repeating doing the same thing for 20 years. And Kohl's is they just appointed their fourth CEO in 4 years, right? Like four CEOs in 4 years. Is that sleepy? No, it might be ridiculous. It might be ill advised, but it's not sleepy. You know what I mean? And Kohl's also in 2022 was attempted to be bought out for way more than it's worth right now. And Kohl's rejected it. So both Kohl's and Target, or sorry, both Kohl's and Macy's, people have tried to buy them and they have not been willing to sell. There's no one specifically that has been trying to take over Target. But look at this article that came out this past November. Target is acting like a company preparing for acquisition. So this is an article that ties to how people thought Amazon would buy Target way back when, pair it with Whole Foods, whatever. And that never happened. I'm not going to read this whole article, but this guy, Chris Walton, a former Target executive, now he's a retail journalist. He's just looking at what Target is doing, looking at the guy that they're bringing in is not actually a different guy. Now, and they speculate why would they do that? He's saying the reason is that Target is clearing the decks for acquisition. It says the situation is so strange that one has to assume that's what they're doing. What other possible explanation could there be? This is a guy that's a former insider to Target. And look at what's happened since that article came out. Right? Here's November 2025. They were $83 a share. They're up 20% since then to 105. So was that the trigger or was it no good news happening between now and then, right? Target has been speculated as an acquisition target, and the choices they are making are indicating that they are an acquisition target. And GameStop, again, Ryan Cohen would not be releasing these statements in January if he hasn't already talked to the company, which means Target probably already knew when they were deciding to just replace their CEO with the COO that wouldn't inspire investor confidence at all. Target probably knows we're going to sell out to GameStop. Cohen probably knows he's going to buy Target, whereas Macy's and Kohl's are actively working on their own turnaround plans. Another reason, Target's 1 year chart much worse than Macy's and much worse than Kohl's. So again, which one is the sleepier management team? And a 5 year also, much worse than Macy's. Macy's up 30%, Target down 42%. So the relative value on a price per sale basis, you're paying a little bit more on a price per sale basis. You're paying a tiny bit more on a PE basis, but you're getting 5 times the revenue capture. It's just crazy to think about a $100 billion company going for almost the same PE as a $20 billion company. All of that scale you basically get for free, or you get for the same price. It's not for free, but the same relative price. Do you want to be a $15 billion or $20 billion revenue company, or do you want to be a $100 billion company? Either way, same price. Same price. It's like paying the same price per square foot in one home that's obviously much nicer than the other home. And people are like, yeah, well, it's just like, I don't know if people are going to want nice homes later. So the bargain might be in this home over here. I'm like, well, if you're paying the same price, it's not a bargain, right? And on a PE basis, you are. And these companies make money. So it's not like it has to be like Target makes over $3 billion a year in net income. So it's like they could be paying off whatever they borrow to make this acquisition in very short order, especially if Cohen rights the ship. Here's another interesting one. This is their head of social media posting on X. Check out this clip. Oh, geez. Make it make noise.
It's never been done before. It's going to need planning and a large crew. What's the target? It's never been.
What's the target? And then he just laughs. Is the head of social media signaling that Target is the target? I think so, but even if he's not, why post this if you're just doing a 2 or a $6 billion acquisition when you have 13 billion at your disposal in cash? Much less, hello, you could issue new convertibles, for example, right? It's just tough to view this type of meme again in conjunction with Cohen saying big, 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 very, very, really, really big. That just doesn't fit with, hey, we made a super calculated purchase for a company that is a meaningful brand but is well supported by their real estate. And even if it doesn't work out, we should end up on the other side, on the good side of it because they're real estate. But, that's kind of what we're going for. Versus a holy smokes. Like, are we talking Target? Are we talking Target? Last one for you here is Ryan's personal connection. So great comment in the video I posted yesterday or Saturday from Dr. Capetto, who's been a regular on the channel. Appreciate you, Doc. Talking about Ryan's personal connection. So the comment was another thought I forgot to mention was that RC tends to see things through a personal lens. He started Chewy because of his pet dog at the time, which is true. Bye Bye Baby because of his 2 young boys. I don't think he ever publicly said that's why he was interested in Bye Bye Baby, but his boys were young. Uh, like they were baby aged, toddler aged when 5 years ago, whatever, 6 years ago or 4 years ago, when he was looking into it, Teddy books because of his dad and the kids. The boys are a little older now, or so, maybe 6 to 9 years old or so. What could be personal for him now? What do kids that are in elementary school need? Target again fits the bill. What else? The answer to what else is nothing. Macy's and Kohl's have much more of a woman's clothing, woman's department store vibe to them. Target has much more of a kid. They also have groceries. They're also not so feminine. Like guys can go there. They have good guys' clothes, and guys know this. Like Macy's and Kohl's very feminine. Target much more gender neutral, still leaning mom, but much more obvious kid presence. Obviously, Macy's and Kohl's are trying to get into it, but I'm just saying, if everything goes perfect for Macy's and Kohl's, one day they might be second fiddle to Target. Or you could just get Target. Okay, that's all I got for you today. I'll see you in the next one. Let me know your thoughts in the comments. Do you think GameStop is buying Target? If not, why? I just laid a lot of reasons, right? It's a lot of reasons. Pretty exciting. If you think that the reason why is you don't think it's a consumer company, right? Like if you exclude some of the conditions, some of the criteria, then obviously the potential list expands. If it's not actually a consumer company, then it expands. If it's not actually larger than GameStop, then it expands, right? If it doesn't actually need to be more efficient, if capital and cost cutting are not actually important parts of Cohen's strategy, if it's not actually a diamond in the rough, right? If it's not actually publicly traded, all these things, right? But if all these things he said are true and important, literally, these are the only companies that even might be on the list. Now, it's totally possible that some of what he said was not that true. Or let me say it like this, it's totally possible that it's loosely kind of retail, but it's not actually. Like, that's possible. It's definitely possible. It's also possible that he strings together several acquisitions at once. Again, that doesn't mean it's not Target, but it could mean that it's more like a Macy's if he's going to try to pair it with 234. But I just gave a lot of reasons why that are unique to Target. That are unique to Target. It's not just, but I think he would pivot if something fell through for some reason. But I don't think he makes this. I don't think he does the interview that he's going to do today. I don't think he makes these articles or does these interviews if the handshake hasn't already happened. I think there's a handful of companies is more of a gesture than a, well, today we just decided to start looking to see who might want to sell to us. And, we're narrowing it down, but, we'll figure it out soon. I think you don't start talking this talk unless you know that you can secure it. And again, is Macy's or Kohl's very, very, very big? I mean, yeah, I think if, I don't think people would be crushed. I don't think it would be too disappointing. But again, you start going down the list, I'm like, okay, it's just not very big, you know? So anyway, so many things making sense. I think it's Target. I could be wrong, okay? And also, he might give us some new nuggets in the interview today with Charles Payne. I wanted to make this video before then to connect all the dots I'm seeing so far, especially if he ends up giving it away in the interview that, oh, it's obviously Target based on something he said. I wanted to get this out there before then so that you guys could know I'm not just that I thought this before the interview. Right? This is what I think. I think DK Butterfly is involved. I think he's going to recapture the NOLs there. I think he's going to roll that into Target. What a bold swing, right? What a bold swing. I think overnight GameStop is a S&P 500 company. I think short squeeze impact is at play from the DK Butterfly shorts. I think short squeeze impact is at play from the GameStop shorts automatically having to be priced as a much higher overall valuation and S&P 500 inclusion, right? And there's nothing he said that doesn't fit these criteria. Target and Macy's. But I Macy's like the only question is this very, very, very big? Like maybe a yellow flat, not quite orange, but is it big enough? Is it big enough? And is department store where he wants to go? It could be. Could be. But I think Target is the I think there's nothing about Target that doesn't meet something he says. And I think there are many things about Target that very uniquely align with what he says and even things that he didn't say. On a price to sales basis, it's a little bit more expensive relative to Macy's and Kohl's, but the upside is astronomically higher. And on a price to earnings, you're basically paying the same. So the earnings pays for the sales, right? Who cares about price to sales if you're profitable? And if you're profitable, you're paying the same multiple with way more upside, way higher base to go from. Tons of potential. I'm pumped. Excited to see what happens. It's a great day to be alive. Great day to be a shareholder, but not financial advice. Okay, that's really all I got for you, at least for now. See you in the next one.